So why
Yeah,
not do it?
All right. Cool. Well, my name's Chris, and we're coming at you from TeamSpeak Whalepool, and we're live streaming at the moment. I'm Chris Ellis, as I mentioned, and I'm joined here by Mayvoon, and we're just going to talk a little bit about technical indicators in trading, and in particular, we're very interested in Bitcoin, and we've been hanging out in TeamSpeak for a while, and we've been comparing war stories, and we've been talking about some of the basics. So what I usually start with when I introduce anybody into trading, and I do so very reluctantly because I really want to try and get people to avoid trading if I can help it, but the realist in me understands that people will fall into that temptation of thinking that they can beat the market. And lesson number one is that you do not decide what you make in a market. The market decides what you make. The only thing that you're really in control of is what you lose. So my number one starting point is in risk management is controlling your losses. And one of the number one reasons why people lose money in trading is because they're trading on emotion, or maybe they're trading for ulterior reasons and they don't even realize why they're really doing it. But they're doing it because they like the thrill or they're hedonistic. There's some other thing that's motivating them. And they're not really thinking about capital preservation, which is why it's often said that markets distribute money from impatient people to patient people. So we'll start off with our favorite, which is Bitcoin. I'm looking at the 4 hour. This is on tradingview.com. I am a paid up member, so I do have some advanced features, but what I wanted to introduce everyone to right now is a very basic feature that everyone should be using. Before we go into like technical candlestick patterns, I feel like it's really important to introduce everyone to the concept of risk reward. So I'm just going to use this tool on the left hand side called risk reward. I'm just going to reveal my tools. Basically, you can click on this tool right here on the left, and what we're going to be doing is we're going to be entering into a long position. So that means that we're going to be betting that the price is going to go up. And May, you feel free to jump in at any point.
Yeah, just do it. You're doing a good job. Chris, you're not talking.
Oh, sorry. So the important thing to understand here is that the risk reward ratio represents the ratio between your win and your loss. So up at the top here, which is where you hopefully want it to go, you're going to be taking profit at this price level right here. So it's indicated on the chart, it's 63708. And your stop loss, which means the point at which you get out of that trade because it's gone against you, is 627.02. That's with a risk reward ratio of 1 to 1. That means it can go up as much as it can go down. In order to really be profitable in the long run in your trading strategy though, you're going to need to make sure that you're running a risk reward ratio of at least 2 to 1, if not more. So that means that you need to take profit expectation up here to 2 to 1. So now you see that you don't take profit until you get to $642. Now, does this mean that you have to be, exact and you don't, come hell or high water, you don't exit that trade until it either goes up to the top here or comes down to the bottom? Not necessarily. Everyone has their own strategy. Sometimes what might happen is that the trade just goes sideways and it's not the trade that you thought you entered into at the beginning, and so you just take whatever profit is there. Some people, and we will talk about this in a later video, like to use what's called a Kelly criterion betting strategy, which is one of my favorites, and we will get to that. But and those people of those schools of thought say, no, you absolutely must wait until the price goes to one of your targets, either your stop loss or your take profit at the top there. Because if you don't, then that means that your losses will not be compensated by your wins. Because look, if you put $1 in here and it goes down and you lose 50 cents on loss, you have to earn at least, $1 or $1.50 on the take profit over time to ensure that you're going to make money back in the long run. The reason being is that you're not going to win every trade. And one of the things that I think is important to learn early on is you shouldn't expect or even try to win every trade. You shouldn't expect or even try to get perfect tops or bottoms in markets. So you see here, if we go back with some hindsight bias and let's clean up the chart a little bit. So hindsight bias would tell us, well, I would have shorted right here, and then I would have longed right on this candle here, and then I would have, taken a short here and longed here. But the point is that you can't predict the future, and past events don't predict future events. Let's take a look at the daily on Bitcoin. We had this big run up back here, back in where were we? May, yes, back in May. And so we started this long run up, and with hindsight, it's easy to see that, this little fella here, this little candle right here would have been the perfect entry, right? And you just would have held it and held it and held it. But human nature being what it is, it's very difficult to control yourself in a market environment, particularly where you've got people shouting and screaming in the sidelines and saying it's going to go up, saying it's going to go down. And one of the biggest mistakes you can make is listening to those people, for number one, and two, not sticking to your plan. I think one of the things I want to teach in this series of videos that we want to do on Whalepool is to get people out of the habit of what's called a FOMO, the fear of missing out, and just help people to devise good bankroll management strategies where whatever your strategy is, whether it's tossing a coin to decide whether or not you're going to enter a trade, or whether you're just only going to trade on prime numbers or something crazy like that, the point is that you stick to it and you keep a record of your trades. And every so once in a while, you go back over your trading record and you actually, look at yourself and you go, right, is this working? What is the performance? What is my expected return? And if it's not working out, just to be honest with yourself and to either stop while you're ahead or cut your losses, because I think a lot of people, they get addicted to their losses. They get addicted to the adrenaline of the trading. Sometimes it's just for the community. They just like the troll box and they like the, hanging out here in Whalepool. But I really wanted to inject some discipline. And May, who's here, well, I guess you can speak a little bit about this, is, really into his poker and, his Monte Carlo and all of this stuff, some of which I don't even understand, actually. I'm really just a very basic trader. I think the only reason that I'm, slightly better than a lot of traders is simply because I have a very basic strategy that I stick to. I don't deviate, and, that has fared me, fairly well over time. So, yeah, May, did you have any thoughts?
So why do you need a 2-to-1 ratio in a certain way that you have to be profitable in the long run? Why is it that?
Yeah, because if you only have 1-to-1, which means that your win will only return you the same as what you might have lost had it gone against you, then over time, statistically, you're not going to have enough profit to make you profitable in the long run, because your wins aren't going to compensate your losses, you see. So if you're always winning 50 cents on the dollar and you're always losing 50 cents on the dollar, then you need a win-loss ratio of over 50% in order to be profitable. And that's actually much more difficult than it sounds. Whereas if you have a risk-reward ratio of 2-to-1 or two, even better, 2 to 2.5-to-1, which I feel is this sort of the optimal one to go for, you're giving the market a tight enough area for the price to move in your favor. And what it means is that on this trade, you would have made $1.50 and you only would have lost 50 cents. So now that $1.50 that gives you extra capital, extra bankroll with which to make future trades, and you would only have lost 50 cents. So now you can actually only have to win maybe 38. I'm not sure exactly what the exact figure is for 2-5-to-1. I think of memory it's something like 38% or 33 to 38% of your trades.
33.5.
33.5, thank you. 33.5 of your trades need to be wins in order for you to break even. So now the only thing you need to get right is the entry and the exit. Once you've got the discipline down, once you've reined yourself in, you've done your 2 hours of yoga and your meditation, and you've really cooled yourself off, and you're not going to look at the troll box, and maybe you hang out here with us in Whalepool, but that's cool. You're not going to let what people say affect you. The only thing now is to decide on what condition do you enter the market. Are you going to be a swing trader? So you're just going to try and pick the oversold and overbought territories and try and catch those kind of swings? Or are you going to look for specific setups? I've got a very basic chart here, but if I turn on some of these features, we've got this set, this candlestick pattern chart that we're very fond of at Whalepool, called SCMR, or Spider Crusher, made by our friend Dan. And you can see here that this particular indicator, and there are many of these, but this is just one of them, changes the color of the candlesticks so that you get these kind of, you still get the red candles and the green candles, and that's fairly self-explanatory. That means that you're either green, that means you're bullish, the price is going up. Red is a bearish, means it's going down. And then you have these gray candles here, that means price is neutral. And then, most importantly, we've got our pivot candles. So the pivot candles are blue, which is a bullish. That means that it predicts an upward price move. And you've got an orange, which is a bearish pivot, which means that the price is going to go down. And all this charting software does is it simply looks at price action. It doesn't look at anything else. So it's not looking at momentum. It's really just looking a few candles back, with his secret sauce. He's done his homework. He's done a lot of back testing, and he has found that there is a particular way in which candlesticks relate to one another over a series of bars that is indicative of a future move. So what we're looking for on our entries and exits in this case is this blue candle. We really like the blue candle when it's followed by another candle with this little circle underneath it. That means a confirmed reversal up. This candle here, this orange one, would indicate that bullish momentum has now been cancelled. But I wouldn't necessarily exit the trade at this point, because remember, if I'm using my risk reward, so let's say here's a good example. Okay, so what we would do here is we would put our risk reward tool on the blue candle, because remember, we don't see that it's blue until it's closed. I mean, we can see it forming, but to get confirmation, we're going to wait for the candle close. And what we can do is we can get an entry on the close of that blue candle. So that will be at the top, not on the shadow, not on the wick at the top, but actually on the close of that blue candle. And then what we're going to do is we're going to set our stop loss to somewhere just below the wick of the previous candle. And we're going to set the top, our take profit area. My recommendation was 2.5 to 1, around there somewhere. And you can see that in that scenario, we would have made profit quite nicely. In fact, in that scenario, with that candle, this big green candle here being what it is, we may have even just allowed it to keep on going and taken profit somewhere up here. But, again, that's hindsight bias. So just because we see this orange candle, once we've entered the trade, the important part, and Flibber says this a lot, the important thing is the entry. It's knowing when to trade. Another big mistake that I think a lot of new traders make is that they trade too much. They trade for no reason. They trade without conviction, without thesis, and that's a very, very bad thing. You may as well, again, just toss a coin or go to the casino and play the roulette table. If you're going to be trading, really it's about risk management, and you're going to be making informed decisions. And the benefit of trading rather than playing the roulette table is that you at least have control over your betting as the market unfolds. So the market's going to give you time to make decisions. And so that's why it's important. There's an old saying, plan the trade, trade the plan. So you plan your trade first, and then you trade that plan and you execute it, faithfully to what you set out, and then keeping a record of that so that you can see how this particular trading strategy performs. So in this example, our trading strategy was to use one of these indicators called SCMR. We enter on a blue candle, we set the stop loss to just below the low of the previous candle so that the price can move, because sometimes it will go against you and then it will go back up. And then to set a stop loss at somewhere like 2.5 to 1. You can do it more. You can do 3 to 1, and then you can, your profits might be higher in the long run. And maybe we'll talk about this in another video, but you can also do something called a trailing stop. A trailing stop is when it hits a certain target and you tell the software, the trading software, to only exit your position if it goes against you by more than $2 or more than by a certain number of percentage points. But that's a much more advanced thing. So, this is the tool that I wanted to show everyone. I'm happy to talk about it more, answer any questions, or you can give your thoughts.
So, if you do it on the last blue candle, for example, would you have still been in the trade?
Which blue candle?
To the left side. There you have the blue candle.
This one here? This one here?
This one, yes.
So if I would have gone in here, let's have a look, see how this would have worked out. Because it will actually change color for you to see whether you would have stayed in the trade. No, you wouldn't have done, because it wouldn't have hit your target. That's, the risk reward there, 2.5 to 1, is way higher. So what would have happened there is, let's have a look. Oh, no, it might be wrong. No, I'm wrong.
Good.
Yeah, still good. Eventually. But this is a daily chart, so you may not have wanted to wait that long, because you may have looked at some of these candles and thought, actually, this isn't real, especially this red one here. You may have decided to get out. I wouldn't personally. I would just stay in, because the thing for me is, like, how much time do I really want to spend, looking at a screen and paying attention to all this stuff? The problem is that it is anxiety inducing. You are dealing with sometimes your life savings or your risk capital, whatever that is. So there is stress involved. And so I think, a lot of the time when people get carried away in the troll box, really what they're doing is they're covering up their anxiety, and, they're shouting their position. Sometimes I've seen people shout the opposite of their position, just because in their heads they seem to think that if they really, really want it to go against them, that maybe fate will somehow cheat them and it will go in their favor, right? So if I'm long Ethereum, I'm going to go, yeah, let's short Ethereum, it's a shit coin, right? and they're only saying that because they actually want it to go up. And there's some really kind of messed up psychology, I think, among some people in this whole industry, in this space. But one of the first industries to really thrive in Bitcoin were the exchanges, and the speculation, particularly Bitcoin, is very high on speculative sentiment. So it does tend to attract that kind of craziness. I think the secret really to winning is to be level-headed when everyone else isn't. When everyone else is being really crazy and they're going berserk, then I think that's the time to be cool-headed.
So if we can see the calibrating criteria to see why we need a 2 to 1 ratio or 2.5 to 1 ratio to be profitable in the long run, or do you want to do it later?
Well, we can do it later, because I think this deserves its own segment and its own show. But this is a spreadsheet I've got up on here. It's a public spreadsheet. I guess we can share this link. I'll share it in the TradingView chat now. So this is the one that I made, but this is actually based off of Dan Jassi's Spider Crusher video that he did, and the link is right there in the actual Google spreadsheet. So if you want to go back to the source, it was really Daniel that suggested this, but I put it all together into a spreadsheet so that you could calculate it yourself. But essentially, and I've explained it here with the annotation, you've got your bankroll, which I'm going to bold there, which is, let's say, $10,000, just for ease of maths. And the percentage of the bankroll used per trade, you can see I've annotated each one of these. So that means that per trade, if you've got an overall risk capital, so not your overall, your bankroll, let's make this clear, your bankroll is not your net worth, okay? Your bankroll is how much capital that you have that you're prepared to risk. And of course, if you're margin trading, if you're going on OKCoin or any of these places and you're borrowing money or leveraging yourself, that's fine as well. So that could turn it, at 10x into 100,000. But this is really what you're prepared to lose if the worst came to the worst. And hopefully you wouldn't, because you'd be a lot more sensible. So the percentage of your bankroll to use per trade is worked out in this row here. So this would be 1% per trade. And so that would be $100 per trade. And the probability is basically, we're saying, right, this is not an exact science, but basically we're saying, okay, what's the probability that we're going to win, overall, 32, we put in 0.32, so that's 32%. And then the risk reward ratio there is 2.5 to 1. And so the average expected return rate per trade with that risk reward ratio is going to be $12. So for every $100 bet you make, you're going to make $12 on average. And then over here we've got, this is how much a Bitcoin is worth, and I put in the stop losses so that you can actually work out, how much to enter into each trade. So what this means is that over time, as you go through, you should probably set up another column or go file and make a copy of this if you want to. Set up another spreadsheet and then actually put in your trades. And what you will find is that with a risk reward ratio of 2.5 to 1, as long as the market is volatile enough and it's moving enough, because we saw back here, if the market doesn't move, if it's just going sideways like it has been here, if you'd entered on here, you see you're not going to get enough movement in the market to really get near your take profit zone, or even your losses. Like if you put it over here, for example, it's not going to move enough. It's maybe it touches on the top, and then it goes against you. So you do have to do there is a little bit of hand holding. I wouldn't suggest you be one of these people that just leaves the trade and doesn't ever go back to it. I think you should keep an eye on it. And TradingView certainly has a really good feature with the alarms. I've got quite a few alarms set up, which warns me about all kinds of markets. And I'm going to show you a particular setup that I like to use with SCMR in just a moment. So yeah, this is a calculation document, but you really need to be keeping a log of all your trades. And again, the reason why you need a risk reward ratio that is more than 1 to 1 is because otherwise your probability, your true win rate, I think it's called, will need to be higher than 50% in order for you to get any kind of profit, let alone break even.
Even with higher than 53%, still a ratio 1 to 1 will wreck you in the future.
Right.
Because the probability of a losing streak is higher than the actual true win rate.
Right, exactly. So another way of that's a good point. So another way of thinking about this with your percentage bankroll is this gives you a certain number of bets. In this case, it gives you 100 bets of $100 each, if this is the one that you choose. So think of it like a computer game, and you've got a certain number of lives. This is how many lives you've got, and you want to give yourself as much runway as you possibly can. That's why, a lot of people get wrecked, because they bet too much, they risk too much, they get over exuberant, and they just put the ranch on, and they think, yeah, this is a sure thing, and it's definitely going to go my way. And there's certainly something to be said for slow accumulation, if that's your thing. If you've got a conviction trade, which Bitcoin is really, it's a conviction trade. People are trading along on Bitcoin because they have this conviction that the state is going to be undermined in the future, the banks are under threat, and so this is going to be the Bitcoin is going to be the new kind of world reserve currency. It might go up to $10,000 and all these kind of crazy figures. So in this case, you can see an argument for a slow accumulation on, sell downs. These big long wicks like this can be quite popular. I know a lot of people leave bids quite low down. They do iceberg orders, which is, this sort of triangular shaped kind of orders down historical levels. So if we pan out here, if we just go to the 3-day, so typically another strategy you can use is these horizontal support and resistance. So this level here used to be resistant up here at $489. So we came down from this low before. And once we had, identified this as a resistance level, we come back up and we attack it here again in April 16. It now, after we break through on this candle in May, it now becomes support. So when the price goes down from this new high, 841, that level here that used to be resistance now becomes the support level for the price. So the market finds stability. Now, in any market, sellers tend to want high stable prices and buyers want low stable prices. The difference really between a speculator and a retail buyer or seller is that when a retailer comes along, you go to the shops as a retailer, you're buying something because you plan to use it, right? It's got utility. But when you're speculating, you're really just spectating, and you are buying something because you think that someone else will value it at more than what it cost you to buy on the day that you bought it. You're really just buying it because you think you can sell it for more than you bought it for. You're not buying it to use it. The thing about Bitcoin and what makes Bitcoin interesting is that you can do both. You can actually just, use your Bitcoin for purchasing things. You can store some away for savings, or you can just sort of gamble them on a lot of these trading platforms. And that makes it unique, I think, among a lot of other asset classes, because it doesn't really care about borders. It goes wherever the internet will let it go. And that means that people can use these various, exchanges in places like Bulgaria and Hong Kong and the Seychelles, and they're registered in all these kind of weird jurisdictions that can sometimes be elusive to the governments in these big Western countries. And so it has attracted a certain type of investor, I think, that tends to kind of whip itself into a bit of a frenzy. Like we had the halvening recently, and everyone then tells themselves a story about how the price is going to go up on a certain day because, the scarcity of the coin is going to go up and so forth. So you can also trade like that. You can trade because you believe in it. You can buy at certain points, like where you see these red candles here, and again, where you see these red candles here, because you're going to say, look, in the long run, I think this thing is going to go up. And that's perfectly okay too. I would be keen to sort of separate that type of trading strategy from this type of trading strategy. If that's what you want to do and you want to do the conviction trading, that's fine. But I would keep a separate spreadsheet and use the Kelly betting as a separate, if I would set up a different account, even like set up another account on your exchange of choice and just keep the ring fence, the funds in your Kelly betting than you do in your thesis-based trading.
So, for example, could you give us an example why you enter a trade, the decision threshold for you to enter a long position?
So this is my current chart of choice. This is the British pound in this case. Let me just correct that. So what we have here is a multi-panel setup using the SCMR. This isn't an ad for Spider Crush, by the way. I'm not being paid by Dan. I just like it a lot, that's all. But it's an example. And you can use, B-bands if that's your thing. You could use high time frame B-band squeezes. I think someone mentioned that the other day. It could be that you buy, the candles like we talked about just there with these big wicks, and you deliberately put bids, so you're going to buy at a previous area of support. So that's another strategy you could use. But my advice is to keep it as simple as possible so that you're not having to make spur of the moment decisions when the time comes. Because again, like I said, one of the biggest reasons people lose money is that they trade with their emotions rather than their logic. And so, like I was saying, the best strategy is when everyone else is losing their head, you want to keep a cool head. That's how you kind of win in this game. So this is the British pound, which I'm now realizing is probably not the best example. I've got my watch list here, which I'll pull out. Let's see if this loads up. It's been a bit slow at the moment, but essentially I can show it to you anyway. So essentially I only enter a long trade if I see a blue candle. So here I've got my 4 hour in this box here, and here I've got my 6 hour. In this box here I've got a 12 hour, 720 minutes, and in the final box I've got a daily. And what I've done is I've told SCMR to disable all the candle colors except for the pivots. except for the pivot candles. So it will still show me the blue pivots, which indicate a bullish momentum, and it will show me the orange, which indicates a bearish momentum. It will still show me the confirmed reversal ups and the cancellations. You see that little X there. It will still show me these pink ones as well. The magenta ones, I should say, indicate that it could go in either direction. It's still a pivot candle. And it's also showing me these dots as well. And these dots will show me, without me having to pan back, they will show me historical areas of resistance and support. They're called dynamic levels. So the reason I have this 4-panel setup is I want to look at long time frames. So I'm not interested in scalping. I'm not interested in short time frames or any kind of, gambling. The reason is because, on the 1-minute chart or even the 5-minute chart, if I just go to that on this bar here, there's a lot of noise, right? So there could be any number of reasons why this price is going up and down, right? Just some hedge fund decides that it's going to dump a load of its dollar holdings and suddenly you're stopped out. Whereas if you trade the higher time frames, more things can happen in that duration. And so you tend to get a buffering effect. And because when we're trading using this sort of risk reward as a percentage, so it's 2.5 to 1, it's a ratio. That means that obviously your ratio will highly depend on the relationship between the candles. It won't be in absolute terms. So I prefer this longer time frame. It's less stressful. It's more averaged out. You're less likely to be stopped out by, a big move down. That's especially true on oil. And as you can see, it's going to come up with alarms as I talk to you, because it's going to start saying, okay, Microsoft is, down, or it's going to go up, because I have alarms that email me whenever it sees on one of the higher time frames a blue candle or an orange candle. And what that will prompt me to do is it will prompt me to go take a look at that chart. And I won't enter every trade. I'm not entering every blue candle. I'm not going short on every orange candle. That's not how it works. But I definitely want to take a lot of the thinking out of my trading. I don't, because every time you think, you're using energy. It's a cognitive resource that you're using. And one of the reasons why I wear black polo necks, for example, everyone, says that I'm cheating, I'm copying Steve Jobs. I'm not. I did that instinctively. I did it because since I was a kid, I could not be asked to think when I woke up in the morning about what to wear. I couldn't be bothered because I recognized at some level that there was a cognitive overhead. There's it's a drain on my thinking. So every night I would just pull out, a polo neck, and I would just leave it, on the table with my jeans, and that's what I would wear the next day, because I've got other things to think about. I've got more cognitive energy that I want to use as a scarce resource for other things in my life. And it's the same with my trading. If I'm staring at a screen and I'm thinking about, oh, do I go in here? What if I miss out on this move? I could make so much money. Look, I could have made money on this one over here. Look, why didn't I short it right there? If you're thinking about that, first of all, the only reason to look left is for these historical points. In my opinion, the horizontal ones are the only reason. It's the same with my polo necks. Yeah, I own a whole bunch of black polo necks. The same reason that I want to keep these charts really clean, because I don't care about all that extra information on the chart about, what it's doing. So I prefer longing to shorting generally. Because I think that when a market goes down, it goes down very differently to shorting. Often short trades are much shorter duration as it happens. I think, there's an old saying that bulls climb stairs and bears take the window. And that's because, markets tend to just crash. And it's, especially if a market, like if we look right now, let's try this. I don't know if it's going to load up yet. It's loading up. So this is the S&P 500. And recently we had come out of a long duration of, all-time highs. We're basically a long duration of sideways movement, oscillation, and then we suddenly reached all-time highs. Well, once you reach those all-time highs, it's impossible now to really gauge where the top is, because it's just going to keep on going until it doesn't. And the problem with that is that you can't really get a sense of where that's going to go. So you short really at your peril in those kinds of situations where there isn't any historical, kind of points to go off of. I'll look at the 12-hour here. So let's pan back. So basically we entered into this new region up here. It's not loading really because I've got too much open, I suspect. But then when we went up into these historical highs at 21.8 and 21.9, really it was anyone's guess as to where it was going to go. Psychological numbers like 2200 are interesting, but I wouldn't risk that on a trade. I wouldn't say like, okay, I'm going to short it here or close to this number just because it's a psychological number, because it's just too risky. So I tend to be very conservative with my trading. I trade, very infrequently. So here it is. So it's loaded up. So yeah, we had a long time of just sideways action, and then eventually we broke out following the Brexit. Actually, the Brexit was about here, I think, and then it kind of recovered, and it ended up going up, pretty big. And that was because people were running to dollars as a safe haven, and then of course they needed somewhere to put those dollars, and so they put them into the stock market. They put them into the 500 leading shares in the US, and also the UK stock market went up as well. So the other thing you can do, of course, we haven't talked about is fundamentals. And people that trade, I guess we spoke about it a little bit with conviction trading, but when people look at fundamentals, they're reading the news, they're looking at analyst reports. Problem with that really is that you have to be a real expert to know what you're doing in those cases, and there's a lot of information to get through, and I don't see how that is statistically going to be more relevant. You can get a better entry point from a piece of software like SCMR or Bollinger Bands than you can reading 10 newspapers a day and glued to Bloomberg, you know what I mean, for your entries. So that's why I only use technicals anyway. So should we wrap it up for now and call it a day?
Let's do that.
Pick it up another time, and we can go into, because you've got a spreadsheet as well with the Monte Carlo strategy.
Yes, that we will do in the next video. I think for entry and exit positions, I think it sums quite up. You need a probability set up that is profitable in the long run, meaning using Kelly criteria or any other betting styles. So you will run plus expected value, because your true win rate or true wins are not that what your future will tell you, because that can change very dramatically. Like I said, if you toss a coin 100 times, you're not expected to have 50 times head or tails. It is more likely to have 70 heads or tails than the opposite.
Yeah, so let's just, as a final recap, I just want to quickly reiterate this point, is that the reason you do not want to go like betting 150% of your net worth on margin on OKCoin is because you want to give yourself runway. You want to get rich as gradually as possible, not try to win your retirement fund in one or two trades. So like May is saying, you could have a scenario where you get into a losing streak, and when you do, you want to make sure you've got as many bets or as much runway, as many lives in that computer game as possible, so that you can come back from those losses and what's called win the loss. So if there's something systemic, there could be that something systemically wrong in your trading strategy, or it could just be that you just happen to enter into a losing streak. But it's important for you to understand the difference between those two. So that's what I want people to take away from this episode today.
I think that sums it up quite good.
Thank you, that's great. So look, everyone, thanks so much for your time. I did a lot of talking there, and really appreciate your attention. If you've got any questions, you can put them in the links in the comments below here on YouTube. And what's the link for this place anyway? This is like twitch.tv/Whalepool. You can check us out. I think it's live all the time, and then occasionally we make these into YouTube episodes sometimes. So you should always be coming back for that, and look forward to seeing you next time.